Hi everyone, I'm Brandon Averill, one of the partners at AWM, where we advise people in creating multi-generational flourishing families so that we can solve that shirt sleeves to shirt sleeves financial epidemic. And this is a front row seat with AWM's Chief Investment Officer, Justin Dyer, and myself, as we discuss some of our clients' most pressing financial questions. This is AWM Insights, and let's dive right in. Hey everybody, welcome back. Justin and I got a thrilling episode here for you. I know we're at least excited. I think we got 14 pages full of notes for today's episode, so we'll try to make it digestible. We're listening to the feedback, and we know we gotta, dial back our nerdiness a little bit. So as we dig into this, we'll try to keep it high level, but still provide the value everybody here is looking for. And last week we talked about what you're actually going to invest in. What are the vehicles? How do you put your money to work? How do you grow it? And where we're going to move today is, okay, great. We know we want to invest in ETFs or mutual funds or stocks or the private markets, etc. But okay, how do I actually go buy these things? Where do I go buy these things? Who could help me in this process? Should I do it all by myself? So we're going to dig into that and really kind of high level. I'll lay out this framework, and then Justin, I'll let you dig into some of the details. But, there's a couple different ways to go about this. So you could, do it yourself. This is going on to, for instance, like Robinhood. Everybody is probably pretty familiar with Robinhood at this standpoint. Or you could go to a retail brokerage shop like a Schwab or a TD Ameritrade or a Fidelity, and you're going to put the investment plan into place yourself, whether it's buying stocks or mutual funds or ETFs. You're going to be the one making all the decisions of how to actually implement your investment philosophy. Then there's this kind of weird little world of, some people doing, you want both the ability to get some advice, but at the same time, they're actually really brokers, so they can't give you the full comprehensive advice. So maybe they're just advising you on an investment portfolio. You're going to find these mostly at your big financial institutions, what we call wirehouses. And what they are is brokers. So your Merrill Lynch's, Morgan Stanley's, Goldman Sachs, etc. These are people, and then there's also the independent kind of hybrid firms. So these are people that can take that brokerage hat and have it on and take it off and give you some advice, kind of at their willy-nilly choosing. So that's another route. And then the last piece is obviously which we're biased in, is going the independent route, giving yourself the flexibility, somebody that can actually give you advice holistically, across your entire net worth. And these are registered investment advisory firms, family offices, etc. But today, what I think we're going to really focus into, I'm going to turn it over to you, Justin, is the do-it-yourself. What if I just want to do this myself? I don't want to go hire somebody else. I don't want that expense. I just want to implement myself. And so we're going to talk about some of the warnings if you're going to do this, how to do it successfully, potentially. And I think this is still applicable, even people that say, hey, there's no way I'd touch this doing myself. A lot of the psychology still affects you. So I think today's episode's still for everybody, but we're going to really look at this and start to talk about what if we're doing this alone. So Justin, I'll stop there. I just talked far too much, more than I usually do, but maybe dig in for a little bit. Like what are some of the considerations as you go at this alone?
Well, let me, man, you went easy on the brokers.
I know.
Man,
that's come on, future episode.
Glorified salesmen. That's what they are.
We got episode 100 coming next week. We're going to dig in there. So a little teaser.
Right. Well, I think that what you hit on at the end there, towards the end, on the psychology of all this is really where we're going to focus a lot. And we touched on that throughout this series, this podcast, and it is really important. Behavioral finance is kind of the broad study of all this stuff, how our minds and psychology interact with finance and decisions around money. And kind of to jump to the conclusion is that really the data doesn't support trying to go about this your own. Even it doesn't support professionals doing it in a certain way, but that's again later down the path here. And really, the why there is from a psychology standpoint, where our minds, our brains are just kind of hardwired. Yeah, you can acknowledge we have these biases in place, and maybe that helps you gain an edge. But there's a hard wiring that we have in place that makes it really, really, really difficult for us to see what's going on in the markets, take in information from the financial media, log into your brokerage account every single minute if you wanted to. You mentioned Robinhood. Robinhood, literally from a business standpoint, is trying to gamify the investment experience, which is not necessarily in your best interest. I would say it's likely not in your best interest. And so all these forces, whether it's external or internal in our own brain, really make this a difficult proposition. And first thing first, you need to kind of set out with a specific goal in mind, and then make sure you understand that the key is to not mess things up by recognizing that you have these biases so that you can protect yourself from making mistakes. Really easy sentence there, way easier said than done. But and we'll kind of define some of the more common behavioral aspects of what you see time and time again in the markets. But really, one of the biggest is fear and greed. You can kind of put those two things together because I think those are real powerful forces within the market. And there's a great quote by Jeremy Segal where he said, "Fear has a greater grasp on human action than does the impressive weight of historical evidence." The historical evidence, and we'll give you some of that, pointing to the fact that you shouldn't really go and try and pick individual stocks, or even hire managers that say they can pick individual stocks. And you know what? Again, kind of getting to a tagline here, or a final point, but we're going to continue to unpack it, is the good thing is you don't have to. Like, you can get an incredible investment experience. You can have an incredible investment experience with very positive, robust results, meet your goals, your priorities, without kind of playing this game. It's kind of like there is a better way. Don't go towards the light, so to speak. Like, let's take a step back. Let's understand the data, and which we hope we're going to really kind of do in this episode, and really at the end convince that that there is a better way to accomplish your goals, and do so which in a way that actually provides better outcomes over the long term. You're not as conducive to these silly kind of fads and whatnot, and maybe you can't speak at a cocktail party as much about your large position in Tesla, although you do own it if you own a diversified portfolio. So you don't have that kind of that itch you can scratch, so to speak. But if you take a step back and understand everything and really appreciate it, you're actually going to likely be better off. So maybe we get into some of these definitions, Brandon, and I'll stop and you hand it over to you.
I think it's a fantastic point, right? Because what you're talking about is the herd mentality. I mean, I was talking with my wife last night about this and just the concept of focus, and I think it relates here. But, I think it's also a time in history where we have to give ourselves a break. There are some pretty powerful multi-billion-dollar companies that are influencing our focus or influencing us to want to be a part of a herd. Owning Tesla, being at that cocktail party, you want to be in that same conversation as all of your friends, whether the data shows up or not. It's a powerful force. So I think also letting yourself off the hook a little bit to know, like, hey, yeah, I know that we talked with one of our advisors, Zach, about this. It's like he gets so passionate, but it's like, I understand the data, and yet I'm still going to make a different decision because there are powerful forces at play. And we see this time and time again. I mean, there's a great stat from 1984 to 1995. The S&P 500 was actually up just over 15% per year. But when they took a look at all the average investors, they were actually only up 6.3%. And so you got to ask the question, like, why? I mean, the data is so obvious. Why in the world would anybody choose to deviate from this? Well, it's because the average investor doesn't want to just sit there and do nothing, right? And that's oversimplifying it. But they want to be in the hot next thing. They want to have the conversation. They want to believe. It's the same as the lottery effect, right? They want to believe that they're going to be the one that's going to outperform at the end of the day. And in the next behavioral bias that comes to mind off of that herd mentality is overconfidence. In my mind, it's the idea, right, that we're excellent. A lot of people are elite athletes listening to this, or very successful doctors or entrepreneurs that built very fantastic companies. It's like, well, shoot, investing's not that hard. If I'm great at this, I've got to be great at this. But we all overestimate our confidence levels, right? Like some of the stuff is really actually hilarious. I thought this was a great one. I read this study that 79% of students said their character was better than most of everybody else. But then they went on in the same survey to admit that 27% of them admitted to stealing something from a store. So not exactly jiving with the character piece. And 60% of them had actually cheated on an exam within the last 12 months. So, character and cheating, that it doesn't totally jive. Or if we're going to bring this back to the finance side, there's a study that they actually looked at a bunch of people's trading. So they were individual investors, looked at their trading activity, and men, not surprisingly, were a little bit more overconfident in general to women. They actually traded 45% more than their female counterparts in this study, and it actually cost them 2.65% per year on average. So, I think at the end of the day, right, we want to believe we're the best. I mean, who in the world says that they're, I think it's the same thing. Go ask all your friends, are you above average looking or not, right? Like there's a reality. Some of us aren't that gifted from the face perspective, and some like Eric are, but
well, and then off of that too, we not only do we kind of inherently believe that, we also seek out confirmation of that belief. We call that confirmation bias, where we have a certain set of beliefs that we kind of start with, don't even know where they come from necessarily. Although, yeah, maybe it's Eric being better looking or whatnot. And then we go and try and confirm that. We will find a fact or disregard other facts that are right in front of our face that contradict that. It's an amazing and really, really powerful behavioral trait that you, even as much as you understand that and try and appreciate it, it's incredibly powerful as well. And I think that confirmation bias and overconfidence really do go hand in hand. There's all sorts of other things. We anchor to certain beliefs as well, or affinities. Like maybe there's a stock you heard that your buddy told you about, and then you bought it, and you anchor to that, regardless of whether or not the facts around that change. You're anchored, and you have this great affinity to hold that, come hell or high water. In some cases, loss aversion, right? We that's the feel that a loss provides to us is far more powerful than the feeling or emotions that a gain provide to you. And so it's not this symmetric kind of rational behavior on that side. Mental accounting is another one. Recency bias, won't really go into all these. You can do quick Google searches on a number of these. Negativity bias, what is that? The gambler fallacy, so on and so forth. There are so many of these things. A lot of them overlap in some ways and shapes and forms, but it is really, really kind of important just to put an underscore or period on all this, that there's very few, if any, traits that I've ever seen from a behavioral standpoint that actually support good investment decision making. Specifically to this conversation, right? There's a lot beyond just investing that our minds always provide challenge with, but it's important to understand that. And again, I think the piece that I want to hit on a couple times here is that there's a different way to play this game that removes a lot of these elements from the playing field in a sense, and and still allows you to really participate and have a phenomenal investment experience and really good results. And again, we always like to bring it back to your unique priorities. What are you trying to accomplish? Why are you investing? And there is a way to do that. One thing I'll kind of wrap up this piece of the conversation around is it's not just the average person either. It's incredibly difficult for quote unquote professionals. You can kind of say that tongue in cheek in a sense, but within, and we should have clarified this at the outset. We are talking public market investing here, and professionals in the public markets there's so much data to analyze them and to do your diligence on what they're doing, what their performance is. And we have many, 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 many years. So it's an incredible, data set, I guess you could call it. And I find this amazing that I still come across folks in our industry that aren't aware of this particular study. But S&P, Standard & Poor's, they've been around for probably 120 years or something like that. They are a data provider. They come out 2 times a year with something called the S&P Index versus Active report. It's SPIVA for short, SPIVA. Put that into Google, and you'll see all this information right there on the homepage. It looks at all of these managed funds from professionals and gives you the statistics on them versus a number of different indices. Just to kind of highlight it for you real quick. This is through June 30th. The numbers through the end of 2021 will probably be out pretty soon here, but through June 30th, 2021, 58.2% of large cap funds underperformed the S&P 500. That's about what you would expect flipping a coin. It's a little bit less than 50-50 because those funds have expenses as well. So that's actually another headwind that detracts from performance. That's for the 1-year period ending June 30th. If you look at 5 years, the number of funds that underperform jumped to 72.6%. Over a 10-year period, 82% of funds underperform. This trend exists in pretty much every single market around the world. It's not unique just to the US. It goes across large cap, small cap, fixed income or not. And then you could take a pause and say, well, okay, can we identify that small sliver, depending on the time frame of 10 to 15 to 20% that outperform? Well, they actually look at that too. It's called persistence. Do the people that outperform in 1 year end up in the same bucket of outperformers the following year? And the very short answer is no, they don't. It actually drops off. And in some studies, you can see that the same people that outperform end up in the very bottom quartile in the following years or the subsequent periods of time. And so that's something you have to ask yourself too when you're thinking about this framework. Well, okay, it's really difficult for professional investors to do this as well. In fact, it's incredibly likely that they're not going to outperform their given benchmark. So why do I have the overconfidence that I can play at that game? But then again, do you need to play that game? I think is the real important piece of it. And are you thinking about your priorities in the right way and structuring your portfolio for the long term, and then controlling the things that you can control, taxes, expenses, and all that stuff. And that's where we're getting into this different game you can play. Like the silly game of just trying to play outperformance is, it's like you guys go over there and do that, and we'll do stuff that it actually has a far higher persistence or more robust outcome to meet your priorities, meet your goals, and actually give you better results over the long term.
Yeah, I think that's a great point, Justin. And all those stats, the underlying effect of how those manifest themselves, right, are because there's this belief and nobody's immune, whether you're doing it yourself or you're a professional investor. If you think you have this overconfidence, that you're influenced by all these biases as well, if you're managing money, and if you allow yourself to have that overconfidence, that belief that you can predict the future, right? At the end of the day, what we do know, again, is there's too many variables to predict short-term market movements. And anybody that's knowledgeable about markets, I don't think they could honestly make those bold short-term predictions. But doesn't stop us from falling victim to some of these biases at times. And, I think I would say for anybody listening to this, think about this the next time that, if you're an athlete, your teammate tells you like, oh, the crypto's got to go up, or your realtor tells you, hey, this market's going to explode and your home value is going to be worth double in the next year or 2 years, or the financial media is on there talking heads saying the market's going to crash this year or it's going to do fantastic this year. You just have to go back to remembering like how hard this is, and they're not immune. And so back to your point, I think, Justin, on this is it all comes back to your plan, right? Your disciplined plan. What we're not saying is that you can't do this, because it's possible. You can do this on your own. It's just that you have to have a really robust plan. You have to remember that these biases exist and you're susceptible to them. I mean, we've gone through tremendous amount. We're susceptible to them as well. The difference is we've gone through a lot of training to recognize these biases and make sure that they're not impacting the plans that we put into place for clients. And so, when we go through and we put together a detailed discipline plan for a client, or you as an individual go through and put your detailed discipline plan together, when you start to deviate because of one of these biases, that's when you have to reel yourself back in. That having a globally diversified portfolio performs over the long term and provides for all of your priorities, and you're at the event with your buddies and they're talking about Bitcoin going to the moon, you have to be able to reverse course and be like, great, good for them, but my plan's solid. My priorities are taken care of. I'm not going to put my financial structure and my family at risk. And that's where the challenge comes in. And if you're able to do that, you can do this on your own. There are other things around the planning world that we'll talk about in the future. We think you could still optimize beyond that. But at the end of the day, you could overcome this, but you just have to be ready for it. And I think that's like some of the takeaways. Make sure that you just remember our brains, like Justin, you started this whole thing, like we're hardwired in a certain way. And so we are fighting very powerful forces at times. Markets are incredibly competitive. Like, why do we believe that we're smarter than other people out there to make predictions or to use the same information everybody has access to make better decisions? That's really difficult. How do you even evaluate your returns? I think that's something we see all the time, right? Like, are you looking at the right metrics? Are you talking about pre-tax returns? Are you talking about after-tax returns? I think people get totally lost on that.
Well, especially in those cocktail party conversations too,
Absolutely.
or party conversations where, oh yeah, I bought Bitcoin at whatever, or Tesla at X. Yeah, okay. How much of that is your portfolio? Is it a small percentage? Is a large percentage? To your point, after tax returns, pre-tax returns, like the susceptibility to get caught up in kind of short-term noise from the financial media, from social circles, whatever, it feeds into this hard to quantify topic that you're hitting on there.
Yeah, and I think 1099s are starting to roll in right now, and the Coinbase 1099s that I'm seeing and Robinhood, it's actually kind of comical because people think they have these big old gains. They're all short term, so they're getting whacked with 50% taxes. It's just, when you think about the risk that happened at times, it's a little dicey. But anyways, we're going to wrap up. We got a little long-winded, but at the end of the day, what we want to close with is just take a step back, slow yourself down, remember to follow that disciplined plan that you've laid out for you and your family. Because I thought this was a great quote. I read it from another investor out there, Peter Mallouk, but he said the car is going to get to its destination unless you personally drive it off the cliff. And I just thought that was a fantastic way to end this. Next week, we got episode 100 coming. We'll definitely bring some fireworks for this one. We're going to talk about actually making the decision to get some advice and partner with somebody. We're going to go through some of the pitfalls and how do you evaluate that. And we'll get into all of that. I know we're already excited about it. So in preparation for that, we're also launching a new way to stay in touch with our community. We'd love to hear your questions about, okay, you know what, this whole do-it-yourself thing, it doesn't sound like something I want to bite off. Like, let us know what you want to hear about. How do you select somebody to partner with? How do you evaluate which financial institution you should go with, etc. Just as some ideas. But we'd love to know what's top of mind for you guys. So text 602-704-5574, and that'll be a text message that joins into our community. It's a place where you can send us feedback and questions for future episodes. That text is coming directly to me, Brandon, so you'll get a text back from me. It'll have you join our community, and then we can go back and forth. And I would just love to hear from you and understand kind of, how you're incorporating some of the lessons that Justin and I are talking about. So we look forward to hearing from you. Again, I'll just say the number again so you have it, but 602-704-5574. And as always, we're going to close this thing out, and I'm going to forget the tagline, but always be a pro.
The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.